Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Tuesday, March 4th, 2025. Today's episode begins with tariffs. If you're a fan of the mainstream media, you're probably hearing a lot about Trump's tariffs and how these are causing the stock market to fall. I don't think so. I don't think that's what's going on. I think it's a lot more nuanced than that. Tariffs usually have an inflationary effect, and yet we're not seeing inflation worries kick in right now, except for maybe gold still near all-time highs. Yet since over a week ago, we haven't seen new highs in gold. If markets were pricing in higher inflation moving forward, the best place to look is the 10-year break-even inflation rate, which measures the difference of yield you can get on Treasury inflation-protected securities versus 10-year note yields. And since the middle of February, this has actually been going down lower and lower. Today, lowering again to 2.35%. It's hard to say if tariffs are playing into credit spreads between junk bonds and treasury bonds, but credit spreads are continuing to spread larger and larger, inching closer and closer to that 3% difference that I've mentioned many times on this show. I've said how odd it is to be below 3%, and now we're going back up towards 3%. So, I don't know how high it's going to go, but credit spreads are widening, and when credit spreads widen, it means companies have to pay more on their debt, which means there's less money of the earnings of the companies to be the earnings of the company. Instead, they just go to the interest payments, and so and that makes sense for stocks to sell off because of that reason. And the credit worthiness is being measured here. How risky is the debt? That's what causes credit spreads to either shrink or widen. And when there's worry about companies not being able to pay off their debt as well, the credit spreads widen, and then the perception is the earnings are not going to be as good in the stocks, and so stocks go down, junk bonds lose value, credit spreads widen, and that's what's happening right now. Things are looking more and more bearish as it stands. Adding to the fire, I just wanted to reiterate the 10-year 3-month is still inverted. This is after re-inverting very recently and not showing like it's going back anytime in the very near future. Of course, the 3-month is only predicting basically the Fed funds rate for the next 3 months, and it's saying the Fed is now behind. It's going to be behind the cuts, and the Fed is essentially strangling the economy. So we have the Fed strangling the economy, credit spreads are widening, stock prices are falling, wealth effect is dropping. This is all a pretty strong setup for a lot of bearishness. Of course, there's seasonality involved. I'm hearing some people talk about how it's common for stocks to sell off in the first part of March, find a bottom, and then halfway through March, basically, things get calm again. We'll see how this works out. Right now, things look a bit frothy. Last agenda item, Friday, we have jobs and the unemployment report coming out. Also, Wednesday, tomorrow, we have ADP employment coming out, which can, give hints as to what the jobs report might look like. If it's really weak, that can mean, there's a good chance unemployment is going to be higher than what we previously expected. But we'll have to see. Friday is the real big report of the week. No major changes in the daily reminders. Watch macro update 211.25 to hear me explain them. And watch Portfolio Update 211.25 to hear me explain my crystal ball ratings and my own portfolio. Again, all the support is very much appreciated. Likes, subscribes, and donations. On to the charts, starting with the S&P 500, the SPX. I mentioned yesterday this red engulfing candle negating Friday's attempt to go higher I said this looks very bearish, and it played out exactly that way. The S&P 500 closing today another 1.2% lower than yesterday's close. Overall, looking very bearish. The VIX also finding new recent highs, and now the VIX futures curve really fully inverted the front end, so we're in panic mode right here. Add to that the advanced decline line it's pointing down along with bearishness. This means things are going down. What else can you say? Additionally, of course, the CNN Fear and Greed Index is sitting in extreme fear, and this is like prolonged fear. This is like it's not a little fire. It's like there's a fire. Things are burning, and the market's not seeing expectations of the fire going out for now. Don't know how long it'll last, but for now it's on fire. TLT still my favorite place to be, dropping by 1.2% after yesterday's large green candle. Is this because of worry of tariffs that yields are suddenly going up? I mean, they're not going up substantially at all. I mean, today's candle opened and closed within the bullish candle of yesterday's candle, suggesting that there's actually more strength in here than there is weakness. I do expect TLT to continue higher from here, especially if volatility increases and the S&P 500 continues to fall and other risk assets tend to continue to lose some price. The rush to safety is typical, and it's what I'm expecting right here. Some people like to use the 10-year note yield as an indication as what the market is feeling about inflation. Break-evens. Use the break-evens. Don't use the yield by itself. You got to look at the break-evens, because that's money betting on inflation itself through the tips market. I mentioned a few days ago I thought we broke out of a trend line. It looked like to me maybe the dollar was gaining strength. The dollar is not strong right now. The dollar is getting bearish here. And this is likely has to do with the tariffs. One kind of little odd of a divergence. A lot of the times, you see the S&P 500 actually going up while the dollar is going down, and then if the dollar is going up, the S&P is going down. So it's interesting that we have the S&P 500 dropping while the dollar is dropping here. My crystal ball says we might actually find a bottom in the dollar long before we find a bottom in the S&P 500. But that's just me and my crystal ball. Crude oil poked its head below this infamous line that dates back to 2021 that I had here, May of 2021. 1, 2, 3, 4, 5, and more recently 6, 7, 8, 9. So this is the 10th time we've bumped on this line, and it hasn't broken yet. And if it does, and I'm expecting it to, if not right now, I am expecting it to happen now. And some chartists that are better than me are seeing that this white line I have here actually a flat line at 65. So my take on it is if we break 65 and retest it, we're unable to get back above 65, again, target $35 a barrel. And that's like things are really falling apart. That's like unemployment, that could be like this Friday's report. If unemployment comes out, let's say 4.5%, something ridiculous like that, that's like chaos mode. That's like oil goes to the ground, yields go to the ground, and we'll have emergency cuts coming in fairly soon. I think this is coming. I mean, remember guys, you're watching a guy literally with a pet dragon and a crystal ball, but I do my best. As previously mentioned, Dr. Copper is unsure what to make of all of this, just being so neutral here, going completely sideways. I think Dr. Copper is waiting for Friday's data. The last chart of the day, MSOS, I bought in I think I first started around this range, 480 range, and I doubled down in the $4 range, and I doubled down again in this range, and wow, this fund is down to $2.78. I mean, there does come a point where it's like, how much money can I put into this thing before I realize how much of my portfolio I've put into it? Like, I mean, I'm certainly not going to sell at this level because I don't think this industry is going to die. I think there's going to be glorious winners that come out of this. There's some leading companies that are, you know, more obviously the front runners in this industry. I still don't think it's going anywhere. I think the fear is overdone, but yeah, wow. I mean, what percent drop is that from the top? I'll calculate it real quick. So why bother with calculators when you have ChatGPT? The drop is 95%. And remember, this isn't of one penny stock or something. This is an entire industry. I have never seen more fear in any market ever, like an entire market, than the cannabis market. I do find this as a very exciting opportunity. I'm gonna have to convince myself to buy more of it at this point. And I probably will eventually it's hard to stomach this, right? Seeing this drop, but this is one of those like blood in the streets, like this is the time, well, for me anyway, to look at it and say, okay, what's my thesis here? Is it correct? Is the, you know, despite how scary it feels when things are insanely cheap, this is the time to get excited. Unless all of the companies in this fund are going bankrupt, I see this as a very exciting opportunity. Even though it feels like, what are you thinking? It's like, it's crazy how that goes. You know, people are all too happy to buy gold at $3,000 an ounce or whatever it got up to. You know, oh, it's expensive. I'll definitely get some. It feels right. That's how the market gets you. That's how people lose, is they follow their emotions instead of their logical decisions. Logic and emotional decisions are often conflict with each other greatly. And in markets, you don't want to be using your emotions, not one bit. So, I mean, who knows? Maybe this entire industry will go to zero and I'll be out of 2% of my portfolio. I'll be okay with that too, and I'll sleep fine at night. But like I've said a bunch of times about this industry in the past. And yeah, and so that's all for today. That's all for me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.